So Workday just grew its artificial intelligence contract value by like 200% year over year.
Yeah, massive growth.
Right. But then you look at their core revenue and it's lumbering along at this seemingly mundane 13%. So what are we actually looking at here? I mean, is this just a dying legacy software company milking its captive audience? Or are we, witnessing the birth of an absolute AI monopoly that's just disguised as an HR platform? Welcome to the deep dive. If you're a retail investor managing your own portfolio, you know the mission of this show.
Exactly. Fast, data forward, no nonsense.
Yep. We do these deep dives to give you opinionated breakdowns of the corporate earnings calls that actually matter. We skip all that Wall Street fluff, we dive straight into the source material and figure out the mechanics of what's actually driving these businesses.
And today's source material provides, one of the most fascinating valuation puzzles in the market right now. We're analyzing the Workday Q1 fiscal 2027 earnings conference call that was held on May 21st, 2026. And Workday, for those tracking the enterprise software space, is a total titan in cloud applications. They handle payroll, human resources, financial management,
supply chain logistics, all of it.
Yeah, for massive global corporations. But this recent earnings call revealed a pretty seismic shift happening right underneath their traditional business model.
Okay, let's unpack this. Because as an investor, you just cannot look at the surface level numbers in the tech sector right now and get an accurate picture. It's impossible.
Totally impossible.
So we're going to rip the Band-Aid off, look straight at the top line data from this Q1 print, and then dig into the actual mechanics of their AI strategy. We need to figure out if ticker symbol WDAY is a buy, a hold, or a sell.
Right.
So I'm looking at the May 21st print here. Total Q1 revenue came in at $2.542 billion, which is a 13% year-over-year growth rate. And look, I'll just say it. In the era of AI supercycles, 13% doesn't exactly scream hyper growth. I mean, these numbers look like a clean beat across the board, but top line growth of 13%. Is this just a mature cash cow milking its existing base, or is there an actual new growth engine here?
It's the latter. That 13% top line number is basically the ultimate camouflage for what's happening with your unit economics.
Okay.
If we break down that $2.542 billion, the composition is what really matters to a retail investor. There's subscription revenue, right? The recurring, highly predictable revenue stream that actually drives the valuation multiple. That was $2.354 billion.
Got it.
And that segment grew a bit faster at 14%.
So almost all of it is subscription.
The remaining $188 million or so came from professional services.
Which, we should probably clarify why professional services revenue even exists for a cloud software company. Usually SaaS companies just want to sell pure software, not, consulting hours.
Right, but implementation is just the necessary friction of enterprise software. Like when a Fortune 500 company buys Workday, they don't just download an app on their phone and create a password.
Yeah, if only.
Right. They have to map decades of bespoke human resources data, all these complex financial compliance rules, crazy organizational charts. All of that has to go into Workday's architecture.
Which takes an army of consultants.
An army. Yeah. Months, sometimes years to execute.
Yeah.
So Workday generates some revenue from managing that friction, but fundamentally it's a low margin drag on their business compared to the actual software subscription.
Sure. But let's get to the number that honestly made every analyst on the call do a double take. The profitability.
Oh yeah. The profitability metrics reported here represent an absolute masterclass in shifting from growth at all costs to elite capital efficiency. Management highlighted a non-GAAP operating income of $809 million.
Hold on. Stop right there. Let's pump the brakes. You just said $809 million, which translates to a highly impressive 31.8% non-GAAP operating margin.
It's massive.
But look, as a retail investor, the minute I hear non-GAAP and enterprise software, absolute alarm bells go off in my head.
Oh, for sure.
Right. Because we know the game Silicon Valley plays, they report these beautiful non-GAAP margins, but only because they exclude massive amounts of stock-based compensation. They pay all their engineers in stock options to hide the real cash expense. So are they actually profitable on a GAAP basis, or is this just accounting gymnastics?
That is the exact right lens to view this through. The whole non-GAAP shell game is a massive issue in the SaaS sector right now. Companies issue hundreds of millions in stock, dilute the retail shareholder, and then claim, hey, look how efficient we are.
Exactly. It's super frustrating.
But Workday's underlying cash flow metrics completely validate the profitability story here. Operating cash flow grew by 52% year over year.
52%.
Yeah, to $696 million.
Okay, 52% growth in actual cash generated from the core business. That is a completely different story than some manipulated accounting metric.
Right. And it gets even stronger when you look at free cash flow. That's the pure cash left over after all capital expenditures. The money the company can actually use to reward shareholders.
Right.
Free cash flow surged 46% to $616 million for the quarter.
Wow.
Yeah, you cannot fake cash in the bank. When free cash flow is growing at nearly 50%, while top-line revenue is only growing at 13%, you are witnessing a company that is fundamentally expanding its leverage.
They're squeezing way more cash out of every single dollar.
Exactly.
So what are they doing with a $616 million quarterly cash geyser? Because if they're just letting it sit in a treasury account yielding like 4%, I'm going to be frustrated as a shareholder, especially considering the stock-based compensation.
Well, they're aggressively addressing that exact dilution concern. During this single quarter, Workday executed $1.6 billion in share repurchases.
Wait, a whopping $1.6 billion? In 1 quarter.
1 quarter.
Okay, that isn't just a token buyback to offset employee stock grants. That's a massive retirement of shares to actually shrink the float.
Yes, and increase the ownership percentage of the existing shareholders. Plus, they still have $1.3 billion remaining in their current buyback authorization.
That's incredible.
And even after spending that $1.6 billion, they ended the first quarter with $4.4 billion in cash and marketable securities just sitting on the balance sheet.
Talk about a fortress balance sheet.
Total fortress.
But, okay, here's where it gets really interesting for me. We've established the cash flow is phenomenal, the margins are expanding. But as an investor looking at the tech sector right now, in 2026, 13% top-line growth feels like a bit of an anchor.
Sure, compared to some others.
Right, because we're in the middle of this AI super cycle. If I'm managing my portfolio, why would I allocate capital to a company growing at 13% when there are AI infrastructure companies out there growing at 80%?
Well, this is where you have to look at the story behind the numbers, the composition of that 13% growth. The headline number is just an aggregate, and it's masking a much more explosive growth engine happening right beneath the surface.
The AI engine.
Exactly, artificial intelligence.
Yeah.
The legacy HR and finance modules are mature, steady, right? But the way they are monetizing AI is explosive.
Let's get into the mechanics of that, because the phrase I saw plastered all over this transcript from their president of product and technology was agentic AI.
Yes.
And we need to translate that Wall Street jargon for the listener right now. When most people hear AI, they think of, the chatbot they use to write an email. How is agentic AI mechanically different from just a standard large language model?
Okay, so a standard large language model is probabilistic. It's a prediction engine that just guesses the next logical word in a sentence. It generates text.
Right.
Agentic AI, the way Workday is deploying it, is deterministic and execution-oriented. These are autonomous software agents designed to complete complex, multi-step workflows. They aren't just chatbots predicting words. They are agents executing actual tasks like hiring, onboarding, expenses across isolated databases.
Without human prompting at every step.
Exactly.
So instead of a user asking a chatbot for advice on how to handle an employee promotion, an AI agent it actually executes the promotion.
Yes. The agent goes into the HR database, identifies the compensation band, checks the finance module for budget availability, routes an approval request to the specific manager, generates the new compensation letter, and updates the payroll system.
Oh, wow. So it doesn't just generate text, it's pulling the actual levers inside the enterprise machinery.
Exactly. It's doing the work.
But wait, to pull those levers accurately, the AI has to really understand the internal logic of that specific corporation, right? Like a generic AI model trained on Reddit doesn't know how a Fortune 500 company structures its approvals.
What's fascinating here is that this brings up their core competitive advantage. Management calls it their world model of work.
World model of work.
Yeah. A generic AI model is useless for corporate execution without context. But Workday has over 80 million users under contract. Their platform processes roughly 1.4 trillion transactions annually.
1.4 trillion, it's hard to even conceptualize that scale.
Right. And for over 2 decades, they've been mapping the exact physics of corporate operations. They have the historical data on how money moves, tax withholdings across jurisdictions, the approval chains. Their AI models are trained on this proprietary logic.
The data structure is the moat. That makes perfect sense. So what did the earnings call say about how customers are actually adopting this? Because every CEO is claiming their AI is revolutionary, but what does the data say?
The proof is in the data. And here's the standout stat of the call. New annual contract value, or ACV, for their agentic AI products grew more than 200% year over year.
200%. Wait, really?
Really?
Okay, so while the overall aggregate revenue is growing at 13%, the AI-specific contract value is tripling.
Tripling. And furthermore, they shared that when an existing Workday customer signs an expansion deal, if that deal includes AI modules, it is over 50% larger on average compared to a non-AI deal.
A 50% premium. That tells me this isn't just some free widget they're throwing in to stop churn. Customers are voluntarily writing massive checks for this.
Absolutely. Because they see the ROI. And a great example of this is the deployment agent game changer they discussed.
Oh, right. Let's talk about that.
We talked about how implementation is painful, right?
Yeah, the low-margin professional services drag.
Exactly. So historically, migrating from an old 90s Oracle database to Workday meant hiring consultants to manually map thousands of data fields.
Total nightmare.
The new deployment agent is an AI tool designed specifically to automate that mapping. And management reported they're already seeing a 30% reduction in total implementation time and costs.
A 30% reduction immediately.
Yep. With a stated goal of hitting a 50% reduction soon. They even said their ultimate mission is $0 deployment in a month.
If they hit $0 deployment, they basically eliminate the switching costs for the entire mid-market. That is wild.
It changes the whole sales pitch.
Here's where it gets really interesting for me, though, regarding the leadership dynamic. Because we heard extensively from CEO Anil Bushery on this call, and he's the co-founder, right? He had stepped away from the sole CEO role for a bit, but now he's back at the helm.
He is.
And I gotta say, some of the rhetoric he used, it made me roll my eyes a little. He explicitly compared his return to Workday to Steve Jobs returning to Apple.
Yeah, it's definitely a hubristic comparison. I mean, Steve Jobs returned to an Apple that was weeks away from bankruptcy. Bushery is taking back control of a company generating over $1 billion in free cash flow a quarter.
Right. Peak Silicon Valley ego.
But the strategic intent is what matters. Bushery wants to bring back a, quote, startup orientation. He talked about fewer layers, faster decisions. He essentially wants to inject paranoia and urgency into a 20,000 employee behemoth.
Which, as an investor, I actually want to see when a platform shift as massive as AI is happening. You can't just coast.
Exactly. Because AI moves so fast. And to back up the rhetoric, Bushery announced that the founder of Sana, which is an AI company Workday just acquired, is the new chief AI officer for the entire corporation.
That's a huge signal. You don't bury a startup founder under 5 layers of VPs. You put them in the C-suite to disrupt your own legacy teams.
Precisely.
Yeah.
And they're already increasing product velocity. They announced the Sana Travel Agent, which autonomously handles travel bookings and expense reports, and Sana for ITSM, which automates IT onboarding.
So it provisions email, software licenses, orders the laptop all automatically.
Yep, blurring the lines between HR, finance, and IT.
Which brings up a big question. Why wouldn't a Fortune 500 company just buy an AI tool from some cutting-edge pure-play startup? Why buy it from Workday?
What's fascinating here is how Bushery explained this. He introduced this concept of lawful versus lawless AI.
Yes, I love this metaphor. Explain the mechanics for the listener, because I think this is their entire economic moat.
Okay, so lawless AI perfectly captures the fear every enterprise CIO has. A pure play AI startup might have a super fast language model. But if you plug that into your corporate database and it hallucinates a financial transaction or bypasses a security protocol to show a junior employee the CEO's salary.
That's a catastrophic liability. It's basically a rogue employee operating at the speed of light.
Exactly. Large enterprises will not buy lawless AI that bypasses security and governance. They need lawful AI, an AI that operates on strict deterministic tracks, verifies security, obeys global compliance guardrails.
Right.
And because Workday has spent over 20 years building this business process logic, their AI sits securely inside that massive trusted world model of work.
It's like a toll booth on enterprise AI. If you want to use AI on your corporate data, it has to go through Workday's compliance engine to ensure it remains lawful, and Workday gets paid either way.
That's exactly it.
So what does this all mean for the rest of the year? Did management put their money where their mouth is for fiscal 2027?
They absolutely did. The guidance provided is where the transformation of their unit economics just becomes undeniable. First, Workday reiterated its FY27 subscription revenue guidance.
Okay, so that's what, 9.925 billion to 9.950 billion?
Yes, which is that steady 12 to 13% growth. But the real news is on the bottom line. They actually raised their non-GAAP operating margin guidance to 30.5%.
They raised margin guidance during an AI supercycle.
Yep.
Every other tech giant is warning Wall Street about margin compression because they have to buy billions in NVIDIA GPUs. How is Workday mechanically projecting higher margins?
It comes down to a dynamic called dogfooding, using their own products.
Yeah.
Management explicitly noted they're using their own AI agents internally. Yeah, in R&D and go-to-market and customer success, they're automating their own corporate operations to realize tremendous productivity gains.
Let me clarify this for the retail investor because this is wild. Wait, so the CEO's goal is to keep their headcount essentially flat for the entire year while still growing revenue by 13%, adding over $1 billion in new sales, purely because their internal AI makes them that much more efficient.
That is exactly the playbook. Anil Bushery stated his goal is to sustain growth but keep headcount flat. They're actively uncoupling revenue growth from human capital growth.
That breaks the fundamental law of SaaS economics. Historically, if you wanted 15% revenue growth, you had to hire 15% more sales reps and engineers.
Not anymore. And on the call, an analyst actually challenged them on this. They asked, hey, if the broader tech sector is laying people off and Workday charges proceed, won't your revenue shrink?
It's a valid, bearish thesis.
It is. But management's defense was revealing. They noted that AI is replacing labor, not software.
Wow. Brutal reality check.
Yeah. If a company uses Workday's AI to automate payroll and fires 200 finance employees, they don't cancel Workday. They become entirely dependent on it. And Workday is shifting its pricing to charge for AI compute consumption, not just human seats.
So they're positioned to benefit from corporate cost cutting.
Exactly.
Okay, we need to pull it all together for the Talk Techers bottom line. We've covered the 13% top line, the massive cash flow, the 200% explosion in AI contract value, the lawful AI moat, and this wild strategy to freeze headcount while growing revenue. Based purely on the data, what is your highly opinionated, actionable verdict for the retail investor?
My verdict is highly bullish. A lot of tech companies right now are just selling AI hype with absolutely zero revenue to show for it. Workday is actually monetizing it today.
Right.
With AI-driven ACV up 200%, expansion deals 50% larger, and their internal AI use driving actual margin expansion. This stock is showing a highly profitable, self-reinforcing AI loop.
A self-reinforcing AI loop. I love that.
Yeah. So for a retail investor, this signals a stronghold or buy. The company is fundamentally transforming its unit economics from a labor-intensive legacy provider into a highly automated AI execution platform.
It really is a fascinating pivot, and it leaves me with a final lingering thought for you, the listener, to ponder as you review your portfolio this week.
Let's hear it.
If an enterprise software giant like Workday can successfully use AI to freeze its own hiring while maintaining double-digit revenue growth, what does that mean for the profit margins of the entire SaaS sector over the next 5 years?
It's a massive question.
Are we about to enter an unprecedented golden age of software profitability? Or conversely, are we looking at a permanent hiring freeze for tech workers? Think about it.
It's the defining question of the decade, honestly.
It really is. Thank you for joining us on this deep dive. Keep analyzing the mechanics, keep questioning the narrative, and we'll catch you on the next one.